Today shocked a lot of people. The headline says interest rates were cut, but markets went red almost immediately. And if you're wondering why stocks dropped after what's supposed to be good news, you're not alone, because this reaction actually makes perfect sense once you understand what the market was really listening for, what it actually heard, and what investors are now afraid of going forward. So let's break this down clearly, step by step, in plain English. First, we need to understand one simple rule of the market. Markets don't move on what happens, they move on what was expected versus what actually happened. And for weeks leading up to today, traders had already priced in a rate cut from the Federal Reserve. Stocks rallied hard before the decision, tech stocks surged, speculative assets ran up, and optimism was everywhere. So when the cut finally arrived, it wasn't a surprise, it was already baked into prices. And when good news is fully priced in, it often triggers the opposite reaction, a sell the news event. But that's only the surface level explanation. The real reason markets dropped goes much deeper than just expectations. It's about the message behind the cut, the tone of the statement, and the economic signals investors picked up between the lines. When the Fed cuts rates, it can mean two very different things. One scenario is bullish, where inflation is under control, growth is stable, and the Fed is simply easing policy to support expansion. The other scenario is bearish, where the Fed sees economic weakness, slowing demand, rising unemployment, or financial stress, and cuts rates as a defensive move. Today, the market decided this cut looked a lot more like the second scenario. During the press conference, investors closely watched every word from Jerome Powell, not just what he said, but what he didn't say, and what stood out was a clear shift in tone. Instead of sounding confident about a strong economy, the language leaned cautious, data-dependent, and concerned about future growth, and that made traders nervous, because rate cuts driven by fear are not bullish, they're a warning sign. Another key reason markets dropped is that the Fed did not promise aggressive future cuts. Many investors were betting on a full rate-cutting cycle, expecting multiple cuts over the coming months. But today's message suggested a slower, more limited path, and that gap between expectations and reality caused immediate repricing across stocks, bonds, and currencies. When markets realized they were too optimistic, prices adjust fast and brutally. At the same time, the Fed acknowledged that inflation, while lower than before, is still sticky in certain areas, especially services, housing, and wages, and this creates a dangerous situation. If inflation doesn't fall fast enough, the Fed's ability to cut rates aggressively is limited, and that means borrowing costs could stay higher for longer than the market hoped, which is bad news for high-growth stocks, startups, and heavily leveraged companies. This is exactly why technology stocks and growth names were hit the hardest today. These stocks depend heavily on cheap money. Low interest rates increase the present value of future earnings, but if rates don't fall as fast as expected, those valuations suddenly look stretched, and investors rush to lock in profits, causing sharp declines. Another major factor behind today's drop is recession fear. Historically, rate cuts often happen shortly before or during economic slowdowns. If you look back at past cycles, the Fed usually starts cutting when something is breaking under the surface, and markets know this. So instead of celebrating the cut, investors started asking a scarier question: what does the Fed see that we don't? Bond markets reacted immediately. Yields moved in a way that suggested growth expectations are weakening, and when bonds start signaling slowdown, equities pay attention, because bonds tend to sniff out trouble earlier than stocks. This bond market warning added fuel to the sell-off. We also saw weakness across major indexes. The S&P 500 pulled back as investors rotated out of risk. The Nasdaq dropped even more sharply due to its heavy exposure to rate-sensitive stocks, and the Dow Jones showed relative strength but still couldn't escape the broader risk-off mood. This kind of synchronized move tells us the sell-off wasn't random, it was macro-driven. Another overlooked reason for today's drop is positioning. Many hedge funds and institutions were heavily long stocks going into the decision. When markets are crowded on one side, it doesn't take much to trigger a reversal. Once prices started slipping, stop losses were hit, algorithms kicked in, and selling accelerated, turning a mild pullback into a sharp intraday drop. Global factors also played a role. A Fed cut impacts the dollar, emerging markets, and global capital flows. The initial reaction strengthened the dollar, which puts pressure on multinational earnings and global liquidity. And when liquidity tightens globally, risk assets everywhere feel the pain, not just US stocks. Let's also talk about earnings, because rate cuts can't fix weak corporate profits. Many companies are already guiding cautiously. margins are under pressure from wages and input costs, and consumers are showing signs of fatigue. Investors are starting to realize that lower rates alone won't magically boost earnings growth if demand is slowing, and that realization hit hard today. This is where psychology comes in. Markets had built a perfect narrative: inflation falling, rates coming down, soft landing achieved, but reality is messier. Growth is uneven, inflation isn't fully defeated, and policy options are limited. When a perfect story starts to crack, markets react emotionally, and that emotion today was fear. Now here's the most important part. A market drop after a Fed cut does not automatically mean a crash is coming. Corrections after major events are normal, healthy, and often necessary to reset expectations. The key question is what happens next, and that depends on data, inflation numbers, jobs reports, and future Fed communication. If upcoming data confirms slowing growth and easing inflation, markets could stabilize and eventually move higher. But if data worsens rapidly, today's drop could be the first warning shot of a larger downturn. That's why smart investors don't panic, they analyze. For long-term investors, days like today are not about fear, they're about opportunity and discipline. Volatility creates mispricing, and mispricing creates chances for those who stay patient and informed. The biggest mistake retail investors make is reacting emotionally to headlines instead of understanding the underlying forces. So to summarize in simple terms, markets dropped today not because the Fed cut rates, but because the reason behind the cut scared investors. Expectations were too high, the message was cautious, recession risks are rising, and valuations were stretched. This combination triggered profit-taking, fear, and a rapid repricing of risk. Going forward, watch the Fed's tone more than the headlines, watch inflation trends, watch employment data, and watch how markets react to bad news versus good news. That reaction will tell you everything about where we are in the cycle. If you're following this channel, Stock Predictor, you already know we focus on understanding the why behind market moves, not just reacting to them, because in markets, knowledge is power, patience is profit, and emotions are expensive. Today wasn't a random sell-off, it was a message, and the investors who listen carefully will be the ones positioned correctly for what comes next.